Welcome to the Mortgage Rate Weekly Market Update for the week of November 19th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage. Here to give you an update. Well, this is Thanksgiving week. I hope you are going to have a safe, happy holiday. But let's jump into the market. We've got some good news here. If you take a look at the bond chart on the screen, you can see mortgage rates hit their 7-year high back at November 8th. But since then, they've actually been able to find a floor of support and rally off of that. So you can see right there, they've been able to rally higher all week. Last week we had green candles, and we ended the week on Friday with a green candle. We broke through the ceiling of resistance at the 25-day moving average. If you look going back, that's been, every time we hit that, we've gotten turned lower since all the way back at September. But we were able last week to break above the 25-day moving average and move up. Looks like we're getting ready to challenge the 50-day moving average. So that's some good news. With that in mind, we're going to recommend floating your mortgage interest rate to start the week to see if mortgage bonds can make a run at that 50-day moving average. Because if they break above that, we can see mortgage interest rates move even lower. Now, one of the questions I get, what's the long-term outlook for rates? Well, rates have been moving higher since December of last year. They're about 1.25% roughly higher. If you got a quote in December, getting a quote now, you know, it's about 1.25% higher than it was on average. Now, one of the things that could help reverse this trend of higher mortgage rates, or at least not maybe reverse it, but stop it from keeping to go higher and higher, is we've got a very strong U.S. dollar right now. And what that does is a strong U.S. dollar tamps down inflation. It lowers commodity prices such as oil. So you may have noticed at the pump, gas has gotten cheaper. Well, that's because the U.S. dollar is getting stronger against other currencies, and oil is pegged to the dollar. So as the dollar increases in value, oil actually prices go down. The second thing, it makes U.S. imports cheaper. This will lower oil prices also and keep inflation down, which is good for long-term rates such as mortgage rates. And then if the U.S. dollar continues to strengthen, the Feds may not continue with their plans to raise short-term interest rates in 2019 because more hikes would further suppress inflation. The U.S. dollar getting stronger suppresses inflation. So if they raise short-term interest rates, they're going to push inflation down even more, which is the opposite of what they want to do. So those are three factors that the U.S. strengthening dollar can have on the economy, and they all are mortgage-friendly news. We'll have to see how that plays out. So we may see mortgage interest rates not move terribly higher from here, so we can hope for that. Now, if we dig into the economic news, the stock market started to become fearful of a recession coming up. And we saw that with them selling off. Take a look at the chart on the screen. This is the S&P 500 index. It sold off at the beginning of October and didn't find a floor of support all the way until the end of October, on October 29th. It was able to rally off of that. But then last week, it sold off again as these traders started thinking about a recession possibly. Now, if we look at historical perspective, recession happens when the unemployment rate is low. And if we look at the historical perspective, every time the unemployment rate dipped below 4.5%, a recession followed about 3 years later. So currently, unemployment rate dipped below 4.5% about a year ago. So if history repeats, we'd be looking at a recession in the summer of 2020. So keep that in mind. We'll see how that plays out. Now, typically in a recession, housing does well because mortgage interest rates will actually go lower, and that'll help people buy homes. So typically in a recession, home prices go up. The last one we had was caused by housing, so that was different. But if you look at the other ones, housing usually does well. So that's another reason to get out there and buy a house now. Now, we saw the Consumer Price Index, or the CPI, for October 2018 come out last week. It increased 0.3% from September, but year over year it moved up from 2.3 to 2.5%. CPI is measuring inflation at the consumer level. Now, if we look at what's called the core CPI, where they strip out food and energy, it only moved up 0.2%, and it actually dropped year over year 0.1% from 2.2 to 2.1%. So we've got to see what's going on with inflation, because if we can keep inflation tame, that's good news for mortgage rates. Then we saw weekly initial jobless claims come out on Thursday. They did move up 2,000 claims to 216,000 claims for the week, but jobless claims remain pretty stable, and they're really, really low. They're at multi-decade lows for initial jobless claims. So employers are holding on good employees. They're not letting good ones go. They're having trouble finding actually good employees to hire. So that is starting to see some wage pressure, inflation there. We'll have to see if that tips its head in the November jobs reports, which will come out first week of December. Now, in the housing news, CoreLogic released their delinquency insights for August 2018. It shows the mortgage market has really recovered. 30 days or more past due decreased from 4.1 to only 4% of all outstanding mortgages. Seriously delinquent loans, which are 90 days or more past due, decreased from 1.6 to 1.5%. And homes in foreclosure remain very stable at only 0.5% of all outstanding mortgages. So the housing market continues to remain very healthy. Delinquencies are dropping. Home prices are appreciating. So we're seeing good news there on the housing front. Now, one of the questions I do get is, should I buy now or should I wait? Well, the answer shortly is, yeah, you should buy, because if you don't, you're going to have what's called a cost of waiting. So if we take an example of someone looking to buy a $200,000 home using an FHA mortgage, only putting down 3.5%, and let's say the interest rate is 5%, APR on that with everything is going to be 5.577%. And that includes your closing costs and all amortized out. Well, if we look at that over a 6 month, if you just waited 6 months, it would cost you about $5,573 because of the amortization increased rate. Rates are going to go up. They are going to go up to about closer to 6%. And then the home price is going up. Now, if you wait 1 year, between the amortization and the price appreciation, you're going to cost you about $11,297. And if you wait 2 years, amortization and price appreciation will cost you about $23,000. And if you wait 3 years between the amortization and the price appreciation, it will cost you about $35,000, almost $36,000. So should you wait? No. You need to get out there and buy now. Now, this doesn't even take effect of the tax advantages, plus it's not taking effect of the money that you're paying to rent right now that you don't get anything for. Because remember, the question is not, do you want to pay a mortgage? You are paying a mortgage. Your landlord's or yours. So the real question is, whose mortgage do you want to pay? So it does make sense to buy, and it makes sense to buy now. You don't want to wait, because you're costing yourself a lot of money over the long term. Now, if we dig into the local news, we got a free first-time homebuyer seminar Wednesday the 28th in Wilmington, Delaware, from 6 p.m. to 8 p.m. at the Independence Mall eXp Realty office. And then next month, we're back in Newark, and that's December 15th. That's a Saturday, 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.